There's a lie I believed for the first 15 years of my career. I know it's a lie because I've now sat across the table from thousands of retirees, and I hear the same thing over and over. We've all been sold this idea: save enough, hit your number, and you're set. Get the 401k balance high enough, and the safety comes automatically. Here's what nobody tells you: that's not just incomplete, it's backwards. Because the more you save inside a traditional 401k or IRA, the bigger the bill the IRS is quietly building against you. Every dollar of safety you accumulate is also a dollar the government has a future claim on. Saving more doesn't automatically mean paying less. It can mean the opposite. I'm James Caldwell, and today I'm going to show you the lie the financial industry sells about enough, and the truth about what actually runs out first if you don't plan for it. Not your money, your window to do something about it. Here's the story the financial industry sells: save enough, hit your number, and you're set for life. The entire retirement conversation gets built around one metric: the account balance. But here's the truth: if you have $500,000 or more sitting in a traditional 401k or IRA, the size of that number isn't the safety it looks like. It's the size of a future tax bill you haven't paid yet. Every dollar in that account is pre-tax money. None of it has been taxed. All of it will be either on your terms, during the years you control, or on the government's terms, starting at age 73 when required minimum distributions begin. At $1 million, your first RMD is roughly $37,000, ordinary income, taxed immediately, at your highest bracket. By 80, past $50,000. By 85, past $65,000. The bigger the balance you were told to be proud of, the bigger that number gets. We were told the goal was accumulation. Nobody finished the sentence. Accumulation without a distribution plan just builds a bigger bill. Here's the second lie, and it's the one that traps people even after they understand the first. The lie says, if you're worried, just save a little more, work one more year, add a little more to the account, and the feeling of security will grow right along with it. I've sat with retirees who had more than enough. The math was done, the projections were solid, and they still wanted one more year for extra cushion. Here's what I've learned after 25 years of this: once you have enough, more money doesn't buy you more security. It just delays the one thing you actually control. That one thing is the pre-RMD window, the years between retirement and age 73, where you decide the pace, the amount, and the destination of every withdrawal. No mandates, no IRS forcing the issue. The lie says, accumulate more. The truth is, the window matters more than the balance, and the window is shrinking every year you wait to use it. Here's the truth that exposes both lies at once. Money isn't your scarce resource in retirement. Time inside the pre-RMD window is. If you retire at 65, you have roughly 8 years before required minimum distributions begin at 73, not 80, not indefinite. 8. And every year that passes without a plan is a year of that window gone permanently. Think about it the way you'd think about anything genuinely scarce. You wouldn't leave a limited resource sitting unused for 8 years and then act surprised when it's gone. But that's exactly what happens to the pre-RMD window for most retirees, because nobody told them it was a countdown, not a permanent feature. The freight tax train is coming. The only question is whether you use the years you have left before it arrives, or watch them pass the same way the money you saved for security quietly waited to be taxed. So if accumulation isn't the answer, and one more year isn't either, what actually closes the gap? There are 3 gears, and they all run on the calendar you already have, not a calendar you have to create. Gear 1. Standard deduction arbitrage. In 2026, a married couple, both over 65, filing jointly, has access to approximately $39,800 in combined standard deductions, including the new $6,000 senior bonus deduction from the One Big Beautiful Bill Act, signed July 4, 2025. If your only ordinary income in a year is a 401k or IRA withdrawal, and it stays at or below $39,800, your federal taxable income is zero, not reduced, zero. 8 years at that pace is $318,400 rescued from the IRS's mandatory distribution machinery, permanently before the balance you are told to be proud of ever gets taxed at the government's rate. Gear 2, the protected tax-free container. That rescued capital moves into a properly structured IUL policy, Indexed Universal Life, governed by IRC Section 7702. Distributions come out as tax-free policy loans. Growth is tax-free. The death benefit transfers to your family income tax-free. The balance stops being a future tax bill and becomes an actual asset, one the IRS has no claim on. Gear 3, the zero loss floor. Inside that container, your money is indexed to the market with a floor underneath it. If the market goes up, you make more. If the market goes down, you don't lose a dollar from that index performance. The cash value inside this policy is classified as a Tier 1 asset, the same category banks use for cash and U.S. Treasury bonds. J.P. Morgan Chase holds billions in life insurance cash value on their own balance sheet. They call it BOLI, bank-owned life insurance. If it's good enough for the largest bank in America, it's worth understanding why nobody explained it to us sooner. Here's what this looked like for a client in Arizona. $1.2 million across a 401k and IRA, retired at 66. He'd delayed for 2 extra years, chasing a little more cushion. When he came to us, he had 6 years left in his pre-RMD window instead of 8. We moved fast, a 6-year conversion plan, maximizing the zero tax withdrawal each year, repositioning into the protected tax-free container. By the time his RMDs started, the balance left in the taxable account was small enough that the mandatory distribution barely registered. He told me afterward, "I thought saving more was the safe move. It was actually the expensive one." He came to us because the feeling hadn't gone away. He had more than enough by any measure. The spreadsheets proved it. And yet every time he looked at that balance, he felt the pull to add a little more. One more year, one more contribution. That feeling was the second lie talking, not a math problem, a planning gap. The window was already closing, and nobody had told him it existed. That's the part I do. Not because it's complicated, but because it requires someone who has watched enough pre-RMD windows open and close to know exactly how much time you have and what to do before it's gone. The One Big Beautiful Bill Act, signed July 4, 2025, permanently extended current tax rates. For the first time in nearly a decade, you can plan with certainty, not guesswork. That $39,800 zero tax window is defined and it's open right now, but it isn't open forever. If you're 65 today, you have 8 years. If you're 68, 5. If you're 71, 2. The lie told us to keep accumulating. The truth is simpler. The years you have left in this window are worth more than the extra balance you'd get from waiting one more year to use them. And here's the part that makes this different from ordinary financial advice. Nobody is asking you to take on more risk, chase a higher return, or gamble on the market to make this work. The entire strategy runs on 2 things that are already true right now: the deduction stack the tax code already gives you, and the years you already have left before age 73. We're not creating anything new. We're finally using what was already sitting there, the part of the story the industry left out when it sold us enough as the finish line. If you're sitting there thinking, "I've done everything right, I have enough, why does this still feel unresolved?" That feeling isn't a math problem. It's the second lie talking. More money was never going to fix it. A plan for the years you actually have left will. Click the link below this video and book a private one-on-one 401k rescue strategy session with my team. We'll look at your specific numbers, your age, your pre-RMD window, and show you exactly how many years you have left to use it and how much you can move through it. Not a sales call, a working session. Bring your most recent IRA statement and your last tax return. That's all you need. Rescue, reclaim, retire richer,